When you're in the middle of a massive acquisition, the accounting rules aren't just some boring compliance thing. They're the playbook. They are literally the rule book for how we recognize, measure, and report on one of the biggest moves a company can ever make. So let's break down the plays, shall we?
So, you're in the boardroom, and the big question always comes up. How do we actually score the deal? I'm not just talking about winning the bid, but how do we account for it in a way that shows its real value? Well, that's exactly where the acquisition method comes in.
And here it is, our playbook. The International Accounting Standard IFRS 3 gives us this super clear 4-step process. It's actually pretty logical. First, we figure out who's buying and when. Second, we value everything we're buying. Third, we measure what we actually paid. And finally, we do the math and see what the difference is. Let's walk through each one.
All right, let's start with step 1, setting the stage. Before you even think about touching the numbers, we got to establish the basic facts of the deal, the who and the when.
It really just boils down to two simple but absolutely crucial questions. I know, it might seem kind of obvious, but the standard says we have to formally identify who the acquirer is and pinpoint the exact date that control officially changes hands.
So who's the acquirer? Simple. It's the company that gets control. Usually they do this by handing over some kind of consideration. That could be cash, other assets, or even by issuing new shares in our own company. Long story short, it's the one paying the price.
And that acquisition date, man, that is so critical. You should think of this as our day one, the exact moment control officially transfers. Every single valuation and measurement we're about to talk about is based on this one single date. It's like taking a financial snapshot of the entire deal, locking in all the values at that precise moment in time.
Okay, on to step 2. Now that we know who's buying and when, we need to figure out, well, what do we just buy? It's time to value the prize.
The central concept here, the absolute heart of this step, is something called fair value. Now, this is not the price on the old company's books. No. It's the price we'd get if we sold an asset or paid to transfer a liability on the acquisition date. It's the true, current economic value of everything we just took on. And getting this right is absolutely crucial.
So you're probably thinking, okay, great, fair value, but how do we actually get that number? Well, you're not just pulling it out of thin air. The standards give us a pretty handy toolkit with 3 established techniques to figure this out.
You've basically got 3 tools in your valuation toolkit. First is the market approach. Pretty intuitive, right? What are similar things selling for out in the market? Then you have the income approach. How much cash is this asset going to generate for us in the future? And finally, the cost approach. If we had to replace this thing today, what would it cost? We just pick the best method for each piece to build that complete picture.
Okay, this brings us to the final and most exciting steps, 3 and 4, the final scorecard. This is where we compare what we gave up to what we got and find out the real financial outcome of the deal.
Step 3 is all about measuring what's called consideration transferred. It sounds a little jargony, but it's really just the official name for the total purchase price. It's the grand total of the fair values of everything we gave up. Cash we paid, assets we transferred, any new debt we took on, and any of our own stock we issued to make it happen.
And now for step 4, the big calculation. Imagine a set of scales. On one side, we put the consideration transferred, what we paid. On the other side, we put the net fair value of all the assets and liabilities we just acquired. If we paid more than what the assets are worth, that difference is called goodwill. But if we paid less, we've just scored ourselves a gain on a bargain purchase.
So, what on earth is goodwill? It's basically an asset that represents the premium we paid for all the awesome stuff we can't individually point to. Things like brand reputation, a loyal customer base, or all the amazing synergies we expect to get. We treat it as an asset because we paid for these future benefits and we expect them to create a ton of value down the road. It goes right onto our balance sheet as an intangible asset.
Now, a gain on a bargain purchase, that's like finding a unicorn. It's super rare. It means we managed to buy a business for less than the fair value of its net assets. If this happens, the first thing you do is double and triple check your math. But once you confirm it's real, it gets recognized immediately as a gain in our profit or loss statement. That's a direct, instant boost to the bottom line.
So, the deal is done. The valuation is complete, but hold on. We're not quite finished yet. There's always the paperwork, right? We still have to account for all the costs of making the acquisition happen. Let's take a look at how that's done.
And this is a really critical distinction. So listen up. Costs that are directly related to the deal itself, like all those fees for lawyers and advisors, get expensed immediately. They hit the income statement right away. But the costs of actually issuing stock as part of the deal, that's treated totally differently. Those costs reduce our equity directly because they're seen as a cost of raising capital, not a cost of buying the business.
And finally, you got to be an open book about this stuff. Transparency is key. We are required to publicly disclose all the juicy details of the acquisition. This means telling everyone the total price we paid, the fair values of what we got, and of course, that final amount of goodwill or any gain we recognized. It gives our investors a really clear picture of what we bought and what we paid for it.
And that brings us to the final and maybe most important question, one that goes way beyond the accounting. We followed the playbook, we did the math, we put goodwill on our balance sheet. But now the real work begins. We have to make sure that the premium we paid for all that future potential actually delivers and starts earning its keep.